Good morning, everybody. Hello to everybody who's not on the East Coast like me. So hopefully you're having a good day. And I haven't looked at the markets yet, but I'm sure it's been a good week for trend and a good week, good month, good year for trend. And it's been a good week for trend following on Twitter. So we had a lot of good stuff going on there this week. I'll throw some topics out there so we can get this group going. Wake up. I got my coffee. I only have an hour today. I'm traveling again. So sorry about that. Yeah, so I tweeted something this week about stocks, trading stocks for CTAs. Just repeating everything I've always said. Um, I posted something again about Netflix. I think that's a great trade. Ackman, I got short Netflix and out of my long and short months ago. And then the smart hedge funds come in and start buying it. And how can we compete against those guys with all their knowledge and staff? And so, anyways, that was a good trend trade. That I kept watching Netflix, hoping that he would have to get out of that, and he did. That was a good trade, a good win for our ideology for now. Oh yeah, I also tweeted about how I trade VIX. So number one, I do have VIX in my portfolio. I'm not saying I would never go long. I mean, never go short, but I definitely have gone long. And I have listened to a lot of Wayne's podcast. I love Wayne. Wayne had a good podcast this week that I tweeted, and he's just like brilliant and has a lot of good thoughts. And his strategy is different from ours, but he knows how to stay alive and what matters. And it seems to jive sometimes with what we believe. Anyways, on this fixed trade, oh yeah, Wayne has mentioned a few times on his podcast that a a price of 80 in the VIX, it's not going to go any higher. So that's my strategy. I buy the breakout for VIX, and then if it gets to 80, I guess I'll get out. I haven't had that happen yet. That's going to be fun. It's going to be different. But it seems to me that once again, it's a small position, and I admitted that it wasn't orthodox or wasn't classic trend following. But I do think it's kind of fun to have to watch VIX and see if I can't participate. Okay, so I think we have the chat. Room chat is open, so put some questions and comments in there if you don't get a chance to speak. Some people are shy; they don't want to speak, so that's a good outlet for them. Okay, so I'll open it up and we'll see what we have going on today. And it's good to be back.
Hi to everyone. As I always say, very happy to be here, and I'm really very happy. Yes, it's maybe a nice week, but when I'm thinking, I thought just now that when I'm thinking about my trading activity, I understand that every day when I follow my rule, and of course we must consistently follow our rules every day. If we will not do this, we will not have our trading activity or our account, I think so. So every day when I'm following my rules is a good day. And it does not depend for me so much on performance. Of course, I have human emotions. Of course, I have. When I see good performance, I'm more happy than when I see not good performance. Of course, so. But first and foremost, I'm sure we must be concentrated. And Jerry said this, and Neil said this, and Maritz and other guys said this many times. We must be concentrated on our system and following these rules, these good rules, of course. So, not sharp or something like that, not the performance of this month or even this year. And we must be strong enough for that, disciplined enough for that. And if we will do so, I'm absolutely sure we will be successful. Of course, if we have good rules.
Oh, yes, another thing we need to talk about, I mean, possibly another good subject that came up is Australian rules football. I'm not familiar with that as much as soccer. And I was trying to provoke Rob into a few arguments or debates and get him going. But um, so, anyways, I'm sure that's a great sport. But I was making fun of football because with the flopping, and I posted something to Rob, I think, about look at Americans aren't so dumb because this flopping that happens in soccer, and I think someone made okay. So then someone said, well, Australian rules football. That's where it's at, Brian. I think so. So you know what I did? I had to Google, do they flop in Australian rules football? And they do. I found just a few cases of doing the same thing. So hey, look, we're here in rough and tough Florida where we play tremendous hockey. So it's no flopping going on there.
Yeah, I think floppers are going to flop anywhere.
So Mark has a question in the room chat. Are time frames fractal in trading? In other words, do the principles apply universally with any time frame, or are some better than others? In my research, back testing, there is just a range of parameters that work, kind of from medium term to longer term. And then I think everything else kind of in between kind of works pretty well. So that's my way of looking at it. I've done that, and that's kind of the way I would just, as I said before, I like to look at shorter term. What's the shortest term I want to trade, and that is going to yield me some trade stats that I pay attention to, like average win, average loss, average trade, win percentage, and then I do some testing to see what's the longest term I want to trade, looking at those same trade stats, and then I probably looked at what happens in between, the variables in between those two, but I'm sure they're great, and I don't really try to cherry pick the best one. So I'll just trade, a good sample in the middle, and then I'm off. And Richard had a great tweet this week. I forgot about that. He kind of picks up on that idea of multiple systems, which mean just multiple entry and exit spots, and how that extends the diversification, the market diversification, somewhat, because we're treating each individual market in hopefully multiple ways that sometimes they're kind of correlated, and sometimes the breakout systems, they all can signal on the same day, or just a day or two apart, but it's still worthwhile to, especially when you're having these big winners, when they start to sell off a bit, to have different exit points, so you don't have to put all your marbles in one stack. You can it'll go down and get out, and then keep going down, or it'll go down, get out of system one, and then go right back to the highs. So that's definitely beneficial. I trade four different systems. I've traded a lot more, and the turtles traded, I think, mostly two systems was probably all we ever did.
Yes, and my first question a year ago when I joined the Clubhouse, and my first question was about system diversification, because I don't do that because of size my account, and Jerry said that only way of system diversification is different different exit enters, but not their different parameters for exit and enters, but it must be all trend following strategies, and it's very important not to mix with other strategies. And I'm sure that there is no, at least there is no sense of mixing with different convergent strategies or any kind of strategies. It's no sense. It's in the very best situation there is no sense, and it in the very best situation it will make your trading activity more complex, and it will make a probability of a mistake or something like that But I'm talking now about the best situation. And I'm absolutely sure that there is nothing that can, like Jerry said to us, there is nothing that can improve pure trend following. And I think there is no sense of doing this. Of course, we can do. It's of course always interesting. We can do our research, and I did a lot of research, and I came to this conclusion, and have maybe a lot of data for this, a lot of different research methodologies maybe I did, and nothing. I have found nothing, and I'm sure because I understand the logic behind the system, and don't think that it's a very good idea to follow to diversify across different markets, more markets as possible. I like this idea if you have a lot of money, of course, on your account, enough money for this. If not, I have told you before that what I do, I try to find uncorrelated return stream. Of course, we understand all that correlations are not something that is constant. Of course, it changes, but a probability of correlation, at least. So, for example, oil, crude oil, and Swiss franc. It's maybe not very high correlation here. So, so here's my point that I liked very much this idea that we must about the system diversification, and I have heard about system diversification, of course, before many times. That it's diversification between systems, trend following systems. All these systems are trend following, and it's a very great point.
Yeah, sorry about that. I was having trouble with my microphone. I was trying to get on before, but had problems. But hi, everyone, and great to be here. Jerry, I was very interested in your long vol tactic. I think perhaps I need to look at that as well. Does that give you some good opportunities in the shorter term space?
Well, um, the way I look at it, Niels, as we've talked about this on Top Traders Unplugged, and there's just this consensus, that you can't trend follow the VIX. And so this is said many times by different people on the podcast. And of course, my contrarian nature is, well, wait a second, because, we got to get into this. And maybe that's true, right? We can't trend follow it. But I listen to Wayne, and I look at, the data, and I think that, probably you can alter it a bit. I think it would just be fun to have that trade on and just to see what would happen. And it's one of 200. So, to me, adding a market is like not even a hard decision. And then doing a trade is not even a hard decision. And then Wayne says, if it gets up to 80, and he even mentioned it again, I think, in this recent podcast about kind of like you don't use a breakout to get out of the trade, the long trade, or you don't use the breakout or moving average. You just kind of, 80 is kind of the max. It's not going to keep going around if it gets up to 80. And so I'm just taking Wayne's word for it. And once again, if you buy it around 20 or 30 and it goes to 80, what harm did you cause yourself? It's just kind of fun, I think, and it's not going to be something I do heavily like you would want to do if you're tail hedging a portfolio of stocks. So to me, it'll be a minimal profit, of course, because most all of my profits are sort of minimal percentage wise. Maybe it'll be a bunch of ATRs, but I'm just kind of playing around and trying to have that in my portfolio just to have some fun with it.
I know Rob has mentioned on Top Traders that he trades a trend following system, so you might be able to bridge some good good common ground with our vol targeting most favorite vol targeting trader there, because he
Is
said
this
he'll cover it in
possible,
his new
Rob?
book. I don't know. He said he'll cover it in his new book, so it'll be interesting to see what he puts out. and how the back tests go. I mean, if he's doing it, obviously it works. It's just how he's applying it. I don't know.
Well,
But
he first
Jerry,
of all thinks that soccer is, he calls soccer football when we all know it's soccer. So, I really don't understand, Rob.
Well, yeah, but Americans and Australians are more first cousins, and our Brits are more second cousins. So it's kind of, I guess, we're a little closer family than we are to the native country.
but Jerry, would you go short the VIX from 80 because, like you say, it kind of can't go any higher?
Oh no, I wouldn't go short at 80. I would, wait for a downside breakout, and but I have a tendency to I may kind of like override that short signal on the VIX. I haven't been short VIX all the way down, so maybe I think I'm just going to do the long side. But that's a good question. Um, if you're from a purely systematic point of view, it sounds contradictory to if you're when you're exiting something and your system is telling you should get out of it. It's still not telling you that you should go short it. Yeah, and then of course because we're still long in other systems possibly. So that is kind of a interesting thing that we play around with, where we're doing these trades but not really making much of a claim for the future. Just it's a game we're playing, and the game it looks like we can win in this game. The back test says we can win, but we're not. Just because we're selling today doesn't mean we're making a claim that we have any clue about what's going to happen, and we're hedging our bets with other systems. And so, yeah, I wouldn't go short. I would just take those profits. But I encourage you to listen to Wayne's podcast on this subject. He gets into a bit of it, and then he doesn't continue giving us all this free information all the time. But he did hit at I know there was one part of the recent podcast where he talks about, well, I wouldn't get out of the trade when it hit 30, but if it had already had a big uptrend and it's coming down and it hits 80, 70, 60, 50, I would get out at 30 then. Something like that. I was trying to pick up on, but he doesn't always give it all to us free on this at the same time.
I've seen some implementations of kind of trend following systems on the VIX that they are mostly for protecting a portfolio. And I've seen both long only implementations that are instead of waiting for breakouts on the absolute number of the VIX, they look for percentiles, right? For example, the 80 percentile or 85 percentile of the history of the VIX from the beginning, and they go along that way. And I also seen implementations that has a short, or that they also short, but when they do that, they add options, long options on the VIX in case if there is an accident. In any case, both ways are in the context of hedging the risk of a portfolio. But it's a different. What I saw in those portfolio VIX strategies is that they are very correlated with a standard trend following system, and also the position sizing is much smaller than what a standard trend following calculation will allow.
Very interesting, Andre. Thanks very much for that. That makes a lot of sense. I was listening to Wayne's podcast, and it always strikes me how similar Wayne is in his philosophical approach to us. And really, the only difference I can see is that he's playing with options with long volatility, where we're playing with classic trend following. But one of the good points he made in his podcast this week was in relation to his viewpoint, which is like ours, this 100% trend or nothing. In other words, he believes that when you have this specific edge that you've developed over very many years, he said, rather than attempt to identify new edges and new opportunities with new edges, focus on how you can adapt that existing edge that you've honed over years. In other words, stick to knitting, focus on the edge that exists in what we do and how you can get using a new approach or a new perspective, targeting that edge in a slightly different way philosophically. And I thought that was a very important point, and it was very interesting.
Yes, I agree. You know, and I think there's a couple of ways I was thinking about it. One is, he agrees with me, and I'm going to stick with what I do, and then maybe try to think of ways to make it a bit better. And so, in sticking to wanting a really robust, low, few rules as I can strategy, then I'm going to concentrate mostly on more markets, right? And I'm going to I'm going to trade stocks, individual stocks. And um, I want to have, okay, so that's what I've done in commodities. And okay, but however, I think that some of our friends who've all managed, they could say the same thing. Oh, that's exactly what I've done. Thank you, Wayne. You agree with me because I have, I've added these markets. That's not really, Jerry talks about this, but it's really not anything special. It's just easy, just add markets. And they won't really want to talk too much about not trading single stocks. But what I've actually done is I've gotten into the system and improved it with these vol management and other ways, even if they stick to the trend following and don't add um, some of the other strategies, carry or pattern recognition or mean reversion and things like that. They will go in and screw around with the trend following piece and add these parts to it that we think, oops, you just crossed over the line. You see, you can't do that. You can try to make it better and stick with what you know, as Wayne is saying, and as Richard just said. But there is a line there. If you go too far, then that's what we keep saying. Oh, you guys have gone too far. And honestly, with the if you're going to force yourself to stick with these systems that have one entry, one exit, and a stop loss, maybe an entry filter, okay, but still, there's not a lot going on there. Then it's pretty easy to stick with what but there's not a lot you're going to ever do with it, which is true with me. I haven't really done that much with the systems. Lengthened them, have been longer term, and then I'm kind of like, okay, I'm sort of stopped, and they work great. So I think it's always in the eye of the beholder and the believer. And when these other guys listen to Wayne, they can come back, take away a whole different attitude than we would.
I'm just going through this chat here, Jerry. Is there anything, any responses we need to make in relation to those questions?
Let's see here. We have one, Jason. Olex says you have two systems. System A trending quiet, consistency profits. System B trending volatile. No, I just have different look back periods, and they all behave the same way. They're not optimized for quiet, consistent profits, and they're not optimized for volatility potential of an outlier. They're all going to hit that outlier, and they're all kind of longer term, so they're not going to be. They're going to absorb a lot of volatility um, in the hunt for that outlier. So all of my systems are unfortunately fairly correlated, and they all behave and are designed to do the same thing. That is, withstand volatility, hang on to the trade as long as possible, and they all make the same amount of money in the back test. The average trade is a little bit lower for the shortest term one, than the longest term one, and that's just a function of it does more trades. It gets out a bit quicker, but they all make about and have about the same win percentage and things like that. So it's just pure diversification, no sacrifice of profits, no different philosophy. Let me know if that doesn't make sense.
No, that makes sense, Jerry. I was thinking if ever you have a situation where your decision is, do I use two different systems or do I use one system? The way I'd tackle that problem is you could either apply 100% bet to a single system, but it's far more preferable to apply two 50% bets to two different systems, provided that they're all classic trend following. They've got the golden rules in them, etc. And the reason I do that is because there is so much randomness in the results of a single system that by always choosing multiple systems, you're going to get a beneficial impact from the reduction of randomness in that joint equity curve or the multiple equity curve as you would in a single return stream.
I wanted only to say that for me personally, I'm quite sure that first of all, we must think about diversifying across the markets. Only this. And the second importance, of course, diversifying across these time frames, exit entries.
Yeah, but what I'd say is this. I'd say if you are using a single classic trend following system, and say you applied it over 50 markets, I'd say that ideally, if you could use 4 classic trend following systems, you will find that you'll be able to increase your market diversification. In other words, if you are applying quarter of the bet size to each of those systems that you do for a single system, that's going to reduce the correlation impact of a single market, and you're going to be able to trade wider with more markets. So you might be able to lift it to 100 markets as opposed to 50 markets, because 50 markets with a single system, you get a higher correlated portfolio than you do with 100 markets. With 4 systems, because it's those 4 systems that are breaking the correlation that exists in a single market. So they're reducing the correlated nature of that market, allowing you to trade more markets, if that makes sense.
Oh yes, I think it makes a lot of sense. I like this. Very interesting idea. I agree with this. I agree with this.
I was just going to say we have a currency this morning that's moving around a lot, and I just my system 1 just went flat, and system 2, 3, and 4 are still long. So, and system 1 may go long here, right? So I've got system 1 is flat, going long. 2, 3, and 4 are still short, and there you have it. And okay, how can you do this? Well, we're playing a game here. I'm going to do these 4 systems for the rest of my life, and all the 4 systems they're positive. They make money. They make about the same amount of money. But right now, they're kind of disagreeing, and they're giving me some diversification. And if this long system 1, if that doesn't work, then I'll get out of a small loss, still be short 2, 3, and 4, or keeps going, I'll be getting out of 2, 3, and 4. So it's a beautiful thing the way it all works, and it, but it it just really helps you to um, live through some of these big moves.
Hi everyone. I've had some troubles with my audio and microphone here, but I think I'm online. On this question of whether to go for more markets or for more systems first, I would approach the question this way. I get that trend following is my approach to trend following is a completely agnostic one. I believe that in the long run, any system, any good enough system will have about 40% hit rate, about 3 to 1 win to loss when applied to any market. and this is not a completely naive belief. It's based on the back tests I've run and on the experience I get from the older turtles here. and and when I think about adding a new market, then I am spreading my bet. I'm making I'm working as a casino that have a lot of players down there working for you, and you're getting a edge from each. But when Jerry says that every system has similar trade stats, that means that I can do this trick that it's as if I am applying trend following to a new set of markets. It's the same markets, but through lens of a different system. And then you can reduce your bet size and reduce the potential of drawdown just by doing this trick of diversifying across systems. That's the way I think on whether to add new markets or add new systems.
Beautiful, Bruno. Totally agree.
Richard, I was just going to say, you tweeted several weeks back, or maybe a week ago, your spreadsheet with all your various systems, and I commented on it, and I think that those series of tweets that you did underscore specifically the benefits about that diversification that we're talking about right now.
Yeah, exactly, Brian. And it really comes from a perspective of almost a hindsight bias. How to, the diversification we use is deliberately done to eliminate this hindsight bias that exists. And when you start looking at multiple return streams as opposed to when you're looking at choosing a single system or choosing a market, there is inevitably this hindsight bias that comes into this statement, and you therefore start overly relying on your back test result. Where the reality is that was basically an overfit result for a historical backtest. So by diversification, what we are doing is we are deliberately underfitting by our method, as opposed to relying on a single market or a single return stream, etc. It's our method of effectively eliminating this overfit nature of reliance on a historical backtest.
I was just going to say, and I think Wayne touches on it too, which is why we have a lot of common ground with him, is being systematic. I mean, I have a friend who's a computer engineer and sells, premium strangles systematically with stop losses and all that. And just when he talks about it, I get physically nauseous because it's just not for me. But he's very successful at it, has traded all the ups and downs, and is systematic. And I think that for us, being systematic and sticking with the process that we know is how you can capture that alpha.
I agree totally. That's one of the key. That's one of the secrets. I don't like these questions about if you could only choose one or two. I mean, we don't have to choose one or two. We can do everything. And what's more important, entries or exits? Rules. People care more about rules. They should care more about position sizing. I don't understand comments like that. I care about everything, and it's all right there to take care of. So just take care of it. And so I think we should absolutely improve our entries and exits, and we should absolutely be very concerned with too many variables and too many rules, essentially. And so our sample size is too low. But if you just are trading these breakouts and you're like, well, this really, I thought I could do better. I want to do better. I think when I listen to people, they're doing things a bit better than me. That's good. I mean, keep trying to improve. That's what you want to do. Um, but the secret is just keep doing it. Don't stop doing it, and don't worry so much about it. And as I've said many times, an average system, a system that's not that great, if it's going to have a big edge, if it's just over a better system that's where the trader is not implementing the system on a consistent basis. So by the mere fact that you're whatever you're doing, I don't want to minimize. It needs to be longer term than you think. It needs to sit there with loose pants and take volatility on and on. But look, you got what you got. Just do it and don't. It's superpower. It's a superpower just to do it. Just keep doing that system and don't stop. I sometimes I sit back and I write down like all the mistakes I've made, or I go back to the last time I wrote down all the mistakes I've made and I add to it. And I remember but it all revolves around two things. And one is not following the rules, being inconsistent, being a weak human and getting out too quickly or not doing the trade that you should do and watching that trend get away from you. And then number two, trading too large, trading small, taking small bets, even if it's only 20 markets. You can definitely take small bets if you're trading 200 like me. But even if you're trading 20, look, you can't risk 1% per trade. I mean, you can, I guess. But for me, I wouldn't be comfortable doing that. And so it's those two things. That is what's hampered me. And nothing really else was that material. If I'd have followed my rules better, if I wouldn't have over traded at certain times, traded too large, trying to make too much money, and suffered the big drawdowns and had to lose confidence and scale back my trade level, on and on. It's just a morass of problems. And yeah, those are the two biggest rules.
By the way, it was great words. Now it only these words, only these few maybe sentences, maybe 10, 15 sentences, can make a person a real trader. It's very great words were said just a few minutes ago, 1 minute ago. And I want to add that, as I remember, Jerry said that, of course, it's all these components are very important. And Jerry said the good words in Systematic Investor that if you are too much leveraged, if you are not have proper risk management, there is no much sense of doing follow the rules, doing these things, because there is risk of that you will put yourself in a situation that account will blow up. So of course all these components, all these factors are very, very important. And we must understand that it's a whole portfolio, whole system. So it's not be much effective one without others. And so thank you for these great words.
How did you pull up after Top Traders Unplugged last week, Jerry?
Yeah, it was good. I forgot exactly what I said on that thing, but I was getting a little bit of harassment from Tim, my good friend Tim, on Twitter after all of that. He was on, I was on. He wants to have this fight with me. He wants to, um, critique me for not having enough crude oil on. But, I think, it's fun to have these debates with people. But I think somebody in my Twitter feed was talking about debating and arguing with people, and you're never going to change anyone's mind. And I feel like that is such the case. And no one's going to probably change my mind too much, not on fundamental core principles, but it's out there. Just do the research and then talk the language. Answer the ultimate question. We put a lot of stuff out there. I do. And I repeat myself all the time. But I'll tell you right now, I've never had one person on Clubhouse, on podcast, anywhere, on Twitter, nowhere answer the fundamental question that I keep bringing up. And that is, when I keep complaining ultimately about vol management um, and anything else that's not real orthodox classic trend following, it's all about one subject, and that is count your sample size. So shut me up. Tell me that you've done it. Tell me that you understand it, that you respect it. Of course, you respect this idea, but I just have it wrong, and just tell me why and address me, you know. But, it's usually you have your way, I have my way, and there's no one right way. And this is coming from smart people. I mean, definitely more math education than me. You would think that they could shut me up.
No, I hear you. One of the big things it's coming across to me is that all of these debates we're having on Twitter, etc., it's this assumption that there is one way to do something, and that's where I'm boldly declaring, well, actually, no, that's not the case. There's actually two extreme spectrums. We live on one extreme spectrum. We're the divergent trader, and our method is almost totally diametrically opposed to what the convergent trader is. So when we start getting into the debates of vol targeting and all of these things, what I say is that you are polluting this divergent technique with a convergent mindset. I personally think that's where this whole argument rests. It's on this principle that it's okay to mix convergence with divergence, which I'm totally opposed to, because when you're looking at the cost of convergence, no one ever sees the cost of convergence, because all they see is a high Sharpe ratio, a smooth equity curve. They're not looking at when those strategies fail. If you look at the long-term validated track record of convergent strategies, you can't find ones that last 30 years. That's because whilst they might have these glorious straight equity curves for 10 years, they've got this negative skew events which suddenly make them meet, risk of ruin head on when you get a major regime change. And this is the risk we're talking about that people refuse to believe exists. It just gets so frustrating to me. So my bottom line is, do not mix convergence with divergence.
Just to get an analogy from a recent discussion, it sounds like using soccer strategies to a football game. They're different games. You're trying to get one technique from one camp into the other that makes no sense at all. And by the way, I've run that back test I was promising you guys with that exercise of measuring the P&L during a trade based on the most recent ATR. It's as if you're reducing or expanding your position based on the expansion or reduction of volatility. And to the surprise of no one, the results are that the trades are worse. The thing is, your average loss is pretty much the same when you compare it to a system that has pretty much the same breakout rules. The hit rate is about the same, but the average win is lower for the system that reduces the position with an expansion of volatility or increases it otherwise. And I think we talked about this 2 or 3 weeks ago, and that was the result I was expecting to get, and well, that's what happened. Apart from the costs of reducing or increasing your position every day, even not considering these costs, this system that has breakout rules, but a new rule that reduces position as volatility expands, the system performs worse.
Bruno, do you think that applying some kind of correlation filter will be the same idea and will achieve the same results?
I have to think more about the correlation, because I can measure the ATR when I am entering the trade. I can measure the ATR during the trade, but the correlation of different markets, it can become really complex, because then times enters enters in the analysis. And when I'm analyzing these trade stats, I'm not doing time. I'm actually trying to avoid it.
I think when you when you introduce correlation, I think I can think of two things that is happening. One is you're now not doing the same trade in every market all the time. You're not buying the 100-day high in this particular market today like you normally would, because the correlation is filter or analysis is telling you don't buy that. So then there's your sample size issue, that you're introducing other rules. And then number two is you're ignoring the fact that highly correlated markets one of those two or three can have a big outlier, and the other one or two may not necessarily do that. I've had that happen. I've mentioned many times in heating oil. Well, a few times in heating oil, and but and then back to what Bruno was saying, I wanted just to comment and say that's exactly what my um, results have been too. With the vol management, is just that they take small profits. The profits are smaller. But then I went one step further. I wanted to see if Bruno concurs with this. Then, in order to make the same amount of money, not per trade, but just in general, you have to trade larger. And so you have to take a bigger position in a bigger potential losing trades. 60% of the trades are losers. So this is a very dangerous thing about capital preservation. Now you're doing something that's not as robust. You're taking more bigger positions, and your average loss needs to be bigger to make the same amount of money, annual return, that you're going to make with the non-vol management classic trend following. And then they have to throw in Sharp. Okay, you're right, but our Sharp is improved, and so now we'll trade bigger because we can trade bigger. Well, only if you look at equity stats, but if looking at trade stats that have a direct impact on your capital preservation, you're going in the wrong direction. You're taking on too much more risk for less money and less robustness.
Yeah, I completely agree. You based on your back test, you can get confidence to trade larger, but that goes against what we do with trend following. The reason we do trend following is that the future is unknown. The past is not you cannot rely upon the past to size your positions. It's not that just because your back test showed you did not blow up, you can confidently go increasing your position, your bet sizes. Oh, from my back test, I get that my steepest drawdown was 40%. Okay, fine. So I can double my positions because 80% drawdown will not kill me. Well, in the past may have not killed you, but you don't know about the future. You don't know if all the trades will go against you at one single time, and then boom, you blow up.
That's
Yeah, you
exactly
don't know
right,
when
Bruno.
you never know when the Fed's going to unleash the liquidity gates.
Yeah, I was thinking all of these decisions we're talking about, things like, such as the impact of correlation, things such as volatility targeting. I've got no doubt that if you imagine our trade distribution, now, all of us classic trend followers, hopefully we've done this, we've looked at our trade distribution over a very large sample size, and we've found that it's only 5% approximately of our trades that make the profit. That's the 95% of the trades of our backtest or of our live trading experience over 30 years or whatever. That is just to keep our head afloat. It's basically 95% of effective randomness. There's 5% that really mean something to us. These outliers, these endogenous events, which we could never predict. Now, undoubtedly, volatility targeting and correlation impacts, etc., they will be decisions based on that 95% of history. But by tampering with that 95% of history, what people don't realize is they are going to impact with a cost of that 5% of those outliers that we want to target. So if they're volatility targeting, or if they're applying correlations or whatever by increasing and decreasing their position size for a particular market, etc., they are going to influence the result of that 5% of outliers in a detrimental way to what a classic trend follower will do. So a backtest will probably always demonstrate, provided the regime has had a long history of fairly good market stability, that it's going to be beneficial to apply volatility targeting, beneficial to apply correlations in our experience. However, in an environment of uncertainty going ahead where, we can't sort of guarantee that we're going to have this extended regime of stability, all bets are off. We might get 10% of our outliers because we're applying this classic trend following approach. But those that are applying these sort of, effectively backtest derived sort of improvements are going to find that the wealth is suppressed.
Yeah, just to make the devil's advocate here, I remember the discussion with Tom, that the clients are looking at the closed, at the open equity, and perhaps from a business point of view, perhaps this makes sense. You're getting a new clients that perhaps will not stay with you for the long run. They get in when you have a lot of large positions on, and to protect these clients at that moment, at the start of their history with you, perhaps that moment makes sense to do some volatility targeting. I don't know. I'm just trying to try to get a glimpse of what makes so much sense for these guys to bring volatility targeting to trend following.
I'm sorry. I have told a lot of times my position here, and I think that I'm right, because if we will do so, if we will ask clients, it's maybe something similar. Let's ask clients how to trade, how to manage the risk. What do they think? Let's do so. So maybe they will trade their own money. And by the way, I have seen, really by myself, I have seen such a situation. Maybe 10 years ago, one guy invested in one trader, maybe not the best trader, but he was a trader, and that guy was only investor. And when this trader was in a drawdown, even it wasn't so. It was May. I remember it was May, maybe 2012 or 2011, and that trader had no exposures. No. And that guy, by the way, he is a businessman in Krasnodar region in Russia. He is a businessman of construction, buildings, and he said that why there was no trades in a month. The money, as he said, the money must work. Money must work, and he did nothing. And he changed the password and began to trade by himself. And I asked him, how do you think that you will, what a probability of losing all this money? I knew all these guys, both these guys. I knew them personally, or both of them. And I asked him, how do you think, what is the probability of you losing all this money because you started to trade instead of this trader in a drawdown of a trader? How do you think? He said, very big probability, but I will do it myself. So I have a very strong position here that we must be very strong, very disciplined, and maximum what can we do is to explain our clients. I have said it before many times, but it's very important. Explain, for me personally, explain our clients how it works, show them charts, logic behind these charts, and tell them, like Neil said and Michael Melisina said and a lot of guys said, tell the benefits of a trend following, benefits. Mark Zebrzynski also says a lot of benefits that no one strategy have trend following, but I think for me personally that it's not. It can't be something that traders, that investors want. They're, like Jerry said, it's crossing the line situation. When investors cross the line, and of course, our strategy must not fit the investor's opinion. Of course, maybe we will. I don't think that, of course, if you will do something like wall targeting and these other things, maybe investors like consistent returns. Of course, they like artificial intelligence. Maybe they like, of course, if you will show them 10% a month, consistent for 5 months or 6 months, I think it will be a lot of assets under management. But sooner or later, you will lose all your money with such type of trading. So, and these investors, they will not say that you are a very good guy after that. That okay, it was so good, but no, not so good, it's okay. No, they will not. They will find another guy who will show 10% a month and will lose their money another time, as I see this. And so, I think only maybe a track record at least from 4 to 5 years, at least so, when you have a such track record, successful track record, and if you can tell about the benefits, you will always maybe I'm not right here, but I think you will always have investors, and it's we must focus first and foremost on our trading and do a little vote track maybe, but for someone it's okay, but it's totally not acceptable for me to listen investors how I must trade and to meet their interests in such way. I'm telling about my own position, my own views here.
Okay,
No, you're
thanks for
right.
all of that.
Sorry, go on.
I just wanted to say one thing in response to all of that, and Bruno, and that is, don't forget, that my research is shows that given all of the faults and all the volatility and all the things that clients don't like, the more classic approach will yield very consistent results. At least over a 12 or 18-month period, it's just going to be more profitable, more consistently profitable than it's going to be highly, I don't know more than what, I'm not sure, but it's going to be, in the 90% of profitable trailing 12-month returns. So look, that's what we're giving them, rightness, robustness, safety, concentrating on that capital and trying to make a good, fair profit, but consistency. So, I had lots, my early years, I think I made money like 8 years in a row. And I had lots of volatility, good profits. People loved it. They're greedy. They love that. They hate the drawdown. It's just that 90% of the CTA trend following industry vol targets. And so that's what everyone should do according to them. But, our strategy will have its day in the sun and ultimately deemed to be superior. Okay, sorry I have to run. I've got to go pack my suitcase, get back to Tampa. It's been fun, and thanks everybody for being there. Thank you, Richard, for taking care of the recording. We really appreciate it, and we'll see everybody back here next week for 2 hours, I promise.
Thanks, everyone.
See you, everyone.
Thank you.
Bye.
Bye.